Hello, everyone, and welcome to this Saturday, June 28th, 2024 edition of the Weekly Market Recap. I'm Tom Bowley, Chief Market Strategist with earningsbeats.com, and it's a pleasure to be with you again this weekend. Wanted to go over a few things that happened during the week, some key rotation that's taking place, and then also talk a little bit about a big upcoming report that we have later this week. Of course, just this past week on Friday, we had the PCE report come out, the PCE price index, and that is the preferred inflation gauge by the Fed. So the Fed is going to have another inflation report to look at that was pretty calm. The annualized return, or the annualized number on the PCE index, what came in at 2.6%. That's the core number. So that strips out food and energy. Last month, it was at 2.8% year over year. So we're seeing that decline continue. And this, again, is a preferred gauge by the Fed. And it's getting closer and closer to that 2% level. So Friday, again, we came out with that number. We did see some decent reaction in the market. And then we saw some selling throughout the day, came back again at the end of the day. Overall, I would say the week last week was fairly quiet. I believe the NASDAQ finished up slightly. The S&P 500 finished down slightly. But really the big story, I mean, if you're looking at it from the surface, it didn't really look like a whole lot took place. But I think when you go beneath the surface, you find that number one of the big things that took place last week was rotation away from the semiconductors once again. So even though we did rebound a little bit on the semiconductor group, what we're seeing is a lot of other areas starting to play catch up and actually beginning to lead. So I want to go through some of those charts with you here over the weekend, get you ready for the second half of 2024. I know it's hard to believe. First half came to an end on Friday. And so now we got to look forward to the second half. What's that going to bring? We've got an election coming up in November. I believe we're probably going to see a little bit of trepidation later this summer as that election draws near. Market doesn't like uncertainty, and I think the presidential election could bring some uncertainty later in the summer months. So I think somewhere down the road, I expect we're going to have a little bit more of a drop. But right now, market still suggests to me that we're going higher. And with Q2 earnings right around the corner. Remember, we kick those off usually the middle of the first month of the calendar quarter. That's coming up middle of July, and we'll usually kick that off with the banks, and that's what's going to happen again this quarter. So got a lot to look forward to. But this upcoming week on Friday, we're going to have the non-farm payrolls out. And I like what I'm seeing in jobs. I mean, last month, for the month of May, we saw that jobs jumped a lot more than expected, clearly more than what we saw back in April. And ordinarily, you would get excited by that news. I mean, that's a good sign. The economy's expanding. We're creating more jobs, that sort of thing. But when you're also fighting inflation and the Fed, you're watching the Fed, who in turn is watching inflation, that can create some difficulties, because when you see an increase in the economy or the GDP or in jobs, it immediately makes you think, oh, well, maybe the Fed will have to wait a little while to cut rates because this could be inflationary, seeing the economy pick up steam. So right now it's a little bit of a double-edged sword. Ordinarily, it would be nirvana for the outlook on interest rates to come down while we're seeing an expanding economy. That is absolutely nirvana. Higher GDP, more jobs being created, that normally is going to result in higher profits for S&P 500 companies. And then those earnings become worth more when rates drop. So it's absolutely normally nirvana. But the problem is there's still fear out there about the inflation rate, whether or not it's coming all the way back down to 2%. And so that leaves us on edge. I think it's all smoke and mirrors. I think the economy remains strong, remains resilient, and I think rates are coming down. I think inflation, which has been coming down for a couple of years, I don't really think poses a huge risk at this point. But those are my feelings. That's not necessarily the overall market's feelings. I know that there's still a lot of folks out there concerned about inflation. I believe we're going to be at an all-time high at the end of this year, even with potentially some weakness later in the summer. So anyway, that's the way I'm kind of looking at everything. But let's go ahead and pull up the first chart that I want to go over. I want to talk a little bit about what happened last week. So this is a weekly chart. Or at least let me just double check this. Make sure I'm looking at weekly instead of daily. So right now showing the Dow down 31. Yeah, it was actually down 45 on Friday. So it's down 31 for the week. So we'll zero in here, get you a little bit better look at what I'm looking at here on the Dow. But you can see the Dow kind of sideways consolidating, not really breaking out to any new highs. I think somewhat stuck between 37.5 and 40,000. Of course, that 40,003 close was a record high close just a couple of weeks, 2 or 3 weeks ago on the Dow Jones. And we're starting to move back up in that direction. But overall, the Dow did struggle a little bit this past week, but finished 39,118.86. So still maybe about a little bit more than 2% away from that all-time high. S&P 500 fell 4 points. So really doesn't seem like much took place, right? Seemed like a pretty quiet week. And overall, it was pretty quiet. But again, below the surface, we got a lot to talk about, and I'm going to here in just a couple minutes. NASDAQ 100, we actually saw a slightly lower low on the NASDAQ 100, at least this past week. But the NASDAQ composite, we saw a little bit of a gain. So the NASDAQ 100, which focuses on more of those big name tech leaders, that actually dropped just a little bit while the overall NASDAQ composite index was higher. Still looking similar to what the S&P 500 looked like, with the NASDAQ 100 dropping fractionally last week. And by the way, you can see the NASDAQ on or last week did set a new all-time record close in terms of intraday prices. Same with the S&P 500. I don't know if you noticed, I think we got up to a high of 55.20 or 55.25. So that was our first move through 5,500. Well, actually, I guess maybe a couple weeks ago we may have touched it, but that was the highest level. The intra-week high this past week was the highest level we've ever seen on the S&P 500. So even though I'm a little cautious and we saw some weakness in some key areas, the overall markets did remain, up near its all-time high closes, weekly closes, and did set an intra-week all-time high. So action wasn't bad. It's just changing. Again, I'll talk about that in just a minute. Mid caps also lost a fraction there, 0.06%, dropping 1 3/4 points. It remains sideways, in sideways consolidation. Maybe we're looking at something that's squeezing like in a symmetrical triangle. That's what it looks like so far. We'll see what happens next week. IWM, very similar. You can see the rising lows, but the declining highs. So we seem to be squeezing in a triangle formation there. Small caps did finish up a little bit more than 1% last week with the IWM. IWM seems to be getting some pretty good support around that 198 to 200 area. I think we dipped just a little bit below 198 this week, and now we're right back up to almost 203. I think we hit 204 during the day on Fridays, early in the day Friday. So the IWM starting to make up a little bit of ground. Still got a long ways to go, though, and really we need to see a breakout above 211. Transports rising here over the last couple of weeks, still below the big moving averages, the 20-week EMA and the 50-week SMA. But overall, actually, I should take that back. The weekly close last week was between the two. It actually was above the 20-week moving average, but did not negotiate the 50. And what we've been seeing is just really chop back and forth. If you look at this, we go below the moving averages and we went back up above. And then we went back down below. Now we're between them. This is more of just a trendless environment. So watching for transports to make a move. If we're talking about rotation and you want an area to begin to lead that would really help the market, you're looking at it right here, transports. We did see some strength, but we need a lot more really to feel good about that area of the market. Looking at sectors, energy last week rising about 2 1/3%. Jumping back up off of a 50-week test, getting back up through the 20-week. So we are positioned going into this week in a much better state as far as energy goes, with price action above both of those long-term moving averages. Communication services gaining a little bit more than 1% last week, moving to new highs. This is good because if we do see a little bit of rotation in the technology area, we want to see other areas step up. Technology last week did move down about 0.75% for the week, but it didn't do poorly. When you look at some of, how some of the semiconductors did, technology didn't finish that badly, and that's because there was rotation within technology to a key area. And I'm going to spend a lot of time talking about that area here in just a couple minutes. When we look at the various industry groups this past week, autos rising more than 7%. That's good news because we're going into July, which is Tesla's quarterly reporting month. That's when they come out with their latest quarterly earnings. And usually this time of year, the autos do really well, especially Tesla. So going to kind of keep an eye on that, but really good week last week as we head into July. Recreational services, check out this breakout. We've had a bunch of moves up near that 110 area. Last week, we jumped to 115.46, rising 746, which was almost 7%, forging to a new breakout level. That was really good news for recreational services. And both of these groups, by the way, autos and recreational services, are in consumer discretionary. And all of a sudden, consumer discretionary is starting to get a little bit of a strength on a relative basis. So maybe losing ground in some areas of technology, that could actually help some other areas of the market. And I think it's going to. And consumer discretionary, I think, could be one of those areas. And then finally, in the industrial area, we had the delivery services group really jump net last week. This is a group that's been in a downtrend for a while, but it got a big lift, no pun intended, by FedEx. FedEx came out with its earnings and tested multi-year highs after a huge gap up. I'll show you that chart in just a little bit. Let's move on. I want to talk about the sectors here. And what I've done here is I've pulled up all of the sectors relative to the S&P 500, and then I'm showing you the last 3 years. So for instance, as we take a look at the technology group, you can see since the beginning of 2023, this group has been crushing it. And if you want to know one reason why the S&P 500 has been so strong for the last year and a half, look no further than technology. That says it all right there. This isn't just technology going up. This is technology outperforming the S&P 500. Now, if you look as we go through these other areas, you're going to see that very, very few sectors are outperforming the S&P 500. Most of these other sectors are going down relative to the S&P 500, and that's because technology is 30% of the S&P 500. And when that group is outperforming the S&P by this much, it's just simple math. When you have outperformance in areas of the market, you have to have underperformance in other areas. And because technology happens to be the largest area, and we've seen such outperformance, it really skews all the other sectors, and they all, for the most part, look pretty weak. Here is discretionary. You can see discretionary since July of last year. So for the last year, we've been downtrending, but we do have a double bottom in play, and we're just starting to turn up. This is an area that I would really focus on. If we continue maybe to struggle, maybe pull back in that technology area, this could be an area that absolutely takes that baton and keeps going. Communication services is probably one of the areas that's done the best over the last year and a half outside of technology. You can see the huge move up, and even recently we've been going sideways, meaning that communication services is going along for the ride with the S&P 500. Then we have industrials, which have taken a big hit here over the past couple of months. Financials, same thing. Healthcare. And as I'm going through this, I've had a lot of folks write in and say, well, what about the recent relative strength in some of the defensive areas? Isn't that a big warning sign? Well, as we look at these charts of the defensive groups, I want you to tell me if you think that these groups are leading the S&P 500. Here's healthcare, one of the defensive areas. since 2023. Now you can see in 2022, we had a cyclical bear market. That's when money rotates to defense. Healthcare did great. Now we're in 2020, well, 2024 now, but look at the last 18 months. Healthcare going straight down. Does that look like outperformance to you? Because it certainly doesn't to me. How about we go over and we take a look at consumer staples? 2022 was going up relative to the S&P. Where are we at right now? Consumer staples on a relative basis just set a multi-year low. So we're not seeing any relative strength in staples. Real estate, another defensive group. You seeing any strength here? I'm not. How about utilities? You know, utilities had a 2 or 3 month run there, right? Look at what's happened since then. Nobody's talking about that anymore. Utilities completely falling apart relative to the S&P 500. Defense is not leading this move to the upside. If you've been hearing that, you're hearing it wrong. Defensive groups have continually been moving lower relative to the S&P 500, even though some of their charts on an absolute basis have made breakouts or are threatening breakouts. That's a good thing. We want these groups to participate on an absolute basis. We want these stocks to go up. We just don't want them keeping pace or outperforming the S&P 500. We don't have to worry about that. It hasn't been happening. Energy has been downtrending since 2023 as well. Hasn't been quite the pace to the downside as some of the other areas. And I actually like energy here in the short term. I think we could see a little bit more relative strength. But we've definitely turned higher here and probably are set up maybe to have a decent month of July. Materials, look where materials are. You really worried about inflation? I mean, all the material stocks collectively relative to the S&P 500 now, multi-year low on a relative basis. I mean, these stocks, if commodity prices are expected to go up, you'd think that there'd be a lot of folks jumping into materials and we might see some relative strength. Not the case. This is another signal to me that inflation is not a problem. It's all talk, smoke and mirrors. Been talking about it for a long time. We are in a secular bull market. Play it for what it is. All right, relative rotation graph. I love these RRG charts. I don't show them enough, to be honest with you. I follow the lines on the relative ratios that I just showed you some of, but I don't think anything visually compares to the RRG. Julius DeKempenaar, good friend of mine, founder of the RRG charts. I mean, this is brilliant. His work is brilliant. Breaking down into 4 different quadrants, how a stock is rotating relative to a benchmark. Here, I've got the SPDR, the SPY, that's the ETF that tracks the S&P 500. That's our benchmark, and I've got all the S&P sectors compared against it, rotating. So the SPDR is right here in the middle. And then everything is either going up or down around it. It's either improving, leading, weakening, lagging, improving. This is the way they move. So watch as I drag this over the past 6 months. Just watch all the sectors go around and around and around. So at various stages, you can see different groups are leading. And of course, different groups are lagging as well. So what you can do, I'm going to pull up the XLK. If you go down here in the bottom and you just click on one of these, it highlights it on the RRG chart. So now as I go through time over the last 6 months, I can look and see what XLK is doing. Now, what you expect, leaders you expect to be over in these 2 quadrants. They lead and they consolidate and weaken. And then they go back up and they lead, and then they consolidate and they weaken, and then they go back up and they lead. But you always stay on the right side of the RRG chart, which measures relative strength. If you're talking about moving up from bottom to top or top to bottom, now we're talking about momentum. So up here in the upper right-hand corner, the northeastern quadrant, if you will, this right here represents strong momentum and strong relative strength. So anytime you're in here and accelerating, it's telling you that this group is absolutely on fire. And the longer the tail is, the better the momentum. in the move to the to the upside. So that's what I look for. I look for areas coming out of improving, going into leading, and then simply rotating mostly. And that's essentially what the XLK does. Now, it does move over into the lagging a little bit, but it doesn't go all the way to the left. Watch it. There, we're just absolute. That right there is explosion. And you can see it's the furthest one out to the right. If you're looking at the chart, it's the furthest sector out to the right. So it's the strongest. It has the most relative strength. And then we get a little bit of consolidation. We quickly move into lagging, and then look at us just explode again. Coming up. Here we go. Boom. So throughout this move, so when we were dropping down on the right side of this chart over here, as the S&P moves down, technology's over on the left side in the lagging and then improving and then lagging, never really gets going. But once we start the uptrend, look at the XLK move into leading. It moved into leading as we made that breakout on the S&P 500, and it stayed. Then we paused for a bit, and as we paused, the XLK weakened a little bit on a relative basis into the weakening area. But then look at this. As we made the move, look at this just absolutely explode back into the leading. And look at, it's the only sector on the right side of the chart. It's the only one that has positive relative strength. Now, as we get closer here, I want you to follow the XLY, which is discretionary, because it's been very weak. For the most part, it's been over on the left side of the chart. Just doesn't seem to sustain anything. But look at it now. All of a sudden, it's ready to make the cross into leading. This is what we want to watch. If that XLY does move into leading, that would be a great sign. Now, some of the other areas right now, let's see, energy, you can see strengthening. Momentum is building. We just don't have enough relative strength yet. Let's see, industrials. Whoops. Industrials, there's industrials. Financials, you can see financials improving. Staples improving. Real estate improving, and there's discretionary. So I would expect the aggressive areas of the market to, at some point, XLK will move back into weakening, and then I think it comes right back up again. I mean, we're kind of seeing that right there at the end with the XLK. Let me get that back up again. So right there, you can kind of see it weakening. The relative strength is pretty much just going straight down. So it's still way off to the right, meaning there's still a lot of relative strength in technology. And I suspect over the course of the next few weeks, we'll probably see this move down and then rotate back up again. And I'll tell you why in just a minute. Software. Well, I'm going to tell you why right now. Software, you see this back? This goes back to the start of the secular bull market back in 2013. Now, some people say secular bull market started in 2009. I'm not going to disagree with that. Technically, it did, but you don't know, you don't get confirmation until you take out the 2007 and 2000 high on the S&P 500. When you take those two highs out, you've got a confirmed breakout. And that, to me, is the confirmation we're in a secular bull market. So I call it 2013. Anyway, since then, look at software relative to the S&P 500. It generally goes up. And 2017 through 2021, it went pretty much straight up. See that? That's not telling us software is going up. That tells us software is crushing the S&P 500. Now, I want you to look at where we are right now and where we were in July of 2021, or excuse me, 2020. So that's 4 years ago. We have basically just gone sideways. We've had downs, ups, downs, now back up. But essentially, we have had no leadership from software for 4 years. I think that's changing. We just made a breakout. Money is rotating out of semiconductors. And now we've got the software moving to these new highs, or at least new relative, well, not really new relative highs just yet, but breaking back up above moving average. I mean, this has been a pretty strong relative strength move. I personally think it's just getting started. I really like software in the second half of this year. Another RRG, this is showing you the technology components. And what I wanted to do here is I'm going to go back to the prior high here in May. I want you to look at what was leading. Here were the stocks that are in green. It's kind of muddled, a lot of different, stocks in here. You can't really get a good sense. But down below, it'll show you the companies that are in this leading quadrant. And look at the industry group: semiconductors, computer hardware, semis, computer hardware, semis, and then one software stock. That was the high in May. I want you to look at the change 1 month later. Let's go down to this again. Now you have two semiconductors, and look at the software. You've got 5, and then in the improving, you've got 1, 2, 3, 4 in the top 6 right here. So you got a bunch of these coming over: Salesforce, Intuit, ServiceNow, Accenture. I mean, you got a bunch of these different stocks that look like they're improving, like they're getting ready to go into the leading quadrant. So that's what's taking place under the surface. We're now seeing a lot of those semiconductor stocks that were in leading. Now look at them. They're all down here in the lagging quadrant. Look at all these semiconductors down here. So if you didn't see it on the charts, on regular charts, you should see it here in the RRG. A lot of these reds over here. I mean, you can kind of see, look at Qualcomm over here. How about Microchip? Actually, Qualcomm coming down there. Microchip on semiconductor. ADI moving into, into that lagging quadrant. So just be aware of what's taking place in the market. I think this is a great visualization. Next thing, look at the S&P 500 components. So I have a chart list that I keep that has nothing but S&P 500 components. And what I did is I looked at the last week, and I pulled up software. I just put that in the search box, and it brings up all of the software stocks. And then it also will bring up any stock that has software in its name. So Paycom Software, even though it's an industrial stock, business support services group, it comes up because it has software in its name. Here's internet stock, Take-Two Interactive, but it has software in the name. So if I put software here, it's picking up more than just the software industry. I just want to make sure you're aware. So just double check. But as you look at these, what I've done is I've put them in scooter order: Stock Charts Technical Rank, which is a relative strength ranking system. And you can see CrowdStrike, which is probably my favorite software stock right now, one of them certainly. CrowdStrike, Oracle, FICO, ServiceNow. I mean, this one's really started to make a move. Let me show you this chart here. After big gap down, I think that was earnings related, but I have to go back and see. I'm pretty sure that was earnings. Since then, we have gone straight back up, and we have erased all of these losses. And in fact, getting back close to that February high. So this is a stock that's gaining ground. The AD line looks great. PPO looks great. So this is one that certainly is kind of moving into that leading quadrant. Next thing, that was the S&P. Here is, I'm going to also pull up the NASDAQ 100 components. I did the same thing: software going back 1 week, CrowdStrike, but then there's another one here, Trade Desk, and of course, Microsoft. Look at Trade Desk, sitting right near its high, ready to make the breakout. You go back 5 years, and it's got its high over the last 5 years up around 115. So it's still got probably about 20% to get up to that high. And I believe we're going to see it in the second half of the year, maybe sooner rather than later. But TTD, I think, looks good. How about Datadog? So Datadog starting to strengthen with volume. Look at the AD line starting to move higher here in June. PPO just went positive. Again, we're seeing the improvement in a lot of these software stocks. And I think it's worth paying attention to, because I think this could be the new semiconductor group. They don't move quite like semiconductors, but this is a group that absolutely can lead the S&P 500 to the upside. As I showed you on that chart, 2017 to 2020 or 2021, software was one of the leading areas of the market for about 4 years. Went through a period just kind of going along with the S&P 500, and now we're just starting to see this relative strength pick up. You definitely want to keep this on your radar. Let's see. I'm not sure why I pulled that one up. We don't need that. And then another thing I did is I ran a scan of the S&P 500 components and the NASDAQ 100 components. And I put this or clause in here. So if it's on either one of these two indexes, I put them into a separate chart list. So here's a chart list of both the S&P 500 and the NASDAQ. Here's 1 week. And so this is just showing you the stocks that led last week. So FedEx, Carnival Corp, Datadog, MongoDB, Team, these three software. Here's another software, Zscaler. So 4 of the, I think it's 516 stocks that are on this list. 4 of them in software. 4 of the top 8 were in software. We had recreational services, the cruise lines, Carnival, Norwegian. You've got FedEx there, and then you've got Tesla autos. Those are the areas that were leading last week, and some of these areas I expect to lead a lot longer. Here's the auto group. So here we made the big move at the end of April, kind of pulled back, consolidated right just above the moving averages for the most part, and then check out here over the course of the last few weeks. Automobiles have broken out above that late April high, and to me, are now testing a very significant area. We gapped down, came back up, essentially filled that gap, and we got all the way back up to 750. And notice that's right where we went to this past week. So if the autos get a little bit more of a lift next week, we could absolutely see a big breakout here that could lead to further strength in July in the auto space. Keep an eye on that area. Tesla, I also wanted to point out, look at the seasonality on Tesla over the past 6 years. I want you to look right here in the middle. July, Tesla's been up every year for the last 6 years, and it averages going up 15.3%. And over the last 6 years, look at the average gains in June, July, and August. 14%, 15%, 13%. You add them up all together, that we're talking about 43%, a little bit more than 43% between these 3 months. That's the average gain in Tesla over the last 6 years. So, and I know some of those were a few years back when Tesla made the big run, but it also in July has been up 100% over the last 6 years. So seems to like the midsummer months, June, July. And as I pointed out on the chart, thought I just had it up. Oh, I had the auto. There is a Tesla chart. Let me pull that up for you. So here, as we're making this run, we're moving into the month of July. If we get through, I'm going to say on Tesla around the 210 area. This is a weekly chart. The 50-week moving average comes in at 211. Let's call it 211, 212. Let's get through that level, because on the daily chart on Tesla, you can see that there is a gap down that occurred about 209. So you've got or maybe 208. So you've got gap resistance at 208. We haven't been able to get through that in the most of 2024. And then also we've got that 50-week declining moving average that we need to pay attention to as well. If we can get through that along with gap resistance, knowing the seasonality for Tesla and the fact that money is starting to rotate back into the autos, this is a stock that can run. It has a history of making big runs into its earnings report. I don't know if that's what's just getting started here, but if it is, you might see a really big move here over the next few weeks in Tesla. Again, worth keeping an eye on. Keep it on in your radar. Let's see, what else did we have? How about the recreational services group just making a big breakout? So talked about Carnival, Norwegian, cruise lines having such a big week last week. Here was the big breakout. We had a double top. We pulled back to the 50-day moving average, came back up. We made that breakout. We're seeing that relative strength in the group right now, something to be aware of as we move forward. The delivery services group, big move up on Wednesday. That was when FedEx reported. And then, of course, just continuing to trade up near the high for the past week. Volume coming in, AD line starting to move, and that PPO has turned positive. So this is an area that looks like it's picking up as well. Now, within the cruise lines and within the delivery services group, I want to just show you these two charts to wrap up today. The first one, Carnival Corp, not quite making a breakout just yet. We have a double top here that we've got to clear. But if we get back above 20, we don't have another major resistance level until we get up to around the 30 level. And that would be another 50% tacked on. So watch for a breakout above the 20 area. I think chasing it right now just under 20 might not be the best thing to do. I'd wait either on a pullback, maybe back to the 15.5, 16 area, or let's get that breakout, one or the other. And then the last one, FedEx, you can see long-term, this is a 5-year chart. Back in 2021, FedEx hit the 300 level. We closed on Friday at 299.84. So we are now testing major long-term overhead resistance on FedEx. A breakout there would be very bullish for the stock. All right, that is it for me today. I do want to thank everybody for watching. Please hit the like button. It certainly helps us in our algorithms and so forth over YouTube. We want to continue to build this community up. I will be posting some other videos from time to time, so make sure you subscribe. Hit that subscribe button and make sure your notifications are on, because when we do publish, we don't have a set schedule. When we do publish, it'll probably be information that you're going to want to see. Time is of the essence with a lot of these different videos, all the charts that I show. So make sure you got those notifications on, and be sure to like videos that we put out. And always, feel free to leave comments, what you think of the video. Maybe you have your own thoughts. I'd like to hear them all. Anyway, have a great rest of your weekend, everybody. Happy trading.